That rand trading around 676 this morning, so that strength maintained. And it looks like, although we have a rising gold price, we also have rising risk appetite and everything playing in the rand's favour at this stage.
Absolutely, Stephen. I mean, the rand continues to be influenced mainly by global developments, but yesterday specifically we also had some barrage of data out of South Africa. We had trade numbers, we also had the PPI, and it seems that after that data came out, on the whole, market expectations of interest rate increases in South Africa increased, and so we saw the rand also strengthen on the back of that.
Well, we saw that gold price rising, being a bit supportive for the rand. We've also seen the carry trade appearing to resume with quite a bit of money flowing into South African bonds yesterday. So, yeah, 3.8 billion over the past week, 1.8 billion yesterday. But these flows can be volatile, can't they?
Yes, absolutely, Stephen. If you just cast your mind back to the earlier part of the year, January, February, we saw some very substantial bond outflows out of South Africa, and the rand weakened slightly on the back of that. So now, as interest rate expectations have increased, it seems that some flavour has returned to South African bonds, and quite a strong inflow into the bond market yesterday, and of course that was reflected in the rand's movements.
Well, let's touch on that PPI number that came out yesterday. Producer inflation rising by 6.7% year on year in February. The market was looking for a figure of around 6.1%, so beating that by quite a margin. And it looks like really commodity prices, and particularly that oil price, pushing it there.
Yes, Stephen, there was quite a large upside surprise that we saw in the PPI, and as you mentioned quite correctly, largely driven by substantial increases in commodity prices. We saw categories like mining and quarrying and basic metals increase quite strongly, and of course they comprise the biggest part of the basket. But added to that, we also saw very strong increases in electricity prices, up about 21% on a year-on-year basis, and of course with NERSA having granted additional hikes, electricity tariff hikes for this year in excess of 20%, it's quite clear that the inflation trajectory for this year certainly seems to have more of an upward bias at this point.
I know the PPI and CPI don't have the same link that they used to have, but does the higher producer inflation change the outlook for consumer inflation prices going forward?
It doesn't necessarily change the outlook in the short term, Stephen, but certainly looking a little bit further ahead, it's quite clear that the risks also to the CPI forecast are mounting, because one of the main drivers, as I mentioned, was electricity prices. That features quite strongly in the consumer price basket, but also fuel prices have been rising, and we see global oil prices continuing to rise. Also, there are going to be additional fuel levies that were announced in the February budget speech that are going to also filter into CPI over time. So at this point, inflation overall seems to be rising quite strongly, and that of course is going to necessitate most likely an upward revision in most CPI forecasts.
Trade balance yesterday as well, deficit of just 350 million rand recorded for February. We had a 4.9 billion rand deficit in January, so a little bit better than expected, because I think we were looking for 1.5 billion rand, but again these numbers are volatile, aren't they?
Well, absolutely, and that sort of dampens one's enthusiasm for yesterday's number. But on the whole, it was good. As you mentioned, the deficit was substantially less than expected, and that certainly bodes well for South Africa's balance of payments, and from a fundamental position also supports the rand. But looking forward, doesn't seem that this kind of very small deficit or even a surplus is going to be sustained, because South Africa is quite an import-intensive means of production, and so as the economy gathers speed later in the year, we'd expect those deficits to continue to widen.
Now, looking ahead, it's been a heavy employment focus this week in the United States in particular. We had ADP numbers on Wednesday, we had weekly jobless claims yesterday, non-farm payrolls this afternoon. So do you think that the market's really going to take direction from what we see coming out of the US this afternoon?
Most certainly. What we have today is the official US unemployment rate as well as non-farm payrolls. So those are always key indicators for the US market. Unfortunately, what we saw is that the ADP report was a tad disappointing. The increase in employment that they reported was less than what markets had anticipated. We also had weekly jobless claims out yesterday, where jobless claims in the week that ended on the 26th of March were also higher than market forecasts. And in addition to that, the previous week, week's numbers were revised upwards. So on the whole, it's not looking very rosy on the employment front. And as far as today's data is concerned, the non-farm payrolls, expectations of the increase in non-farm payrolls have actually moderated since the beginning of the week, following all of that slightly disappointing earlier data. So certainly will be a key bit of data to look out for today.